Let's touch base with our special guest this morning to talk about the markets. Ashwini Agarwal, co-founder and partner of Ashmore Investment Management, joins in with his views. Ashwini, it's great to have you on the show. Thanks very much for taking out the time. Where do we start? We are on the brink of, seeing earnings trickle in for Q4 for the closeout of FY18 and for the start of FY19. Give us your sense of what specifically you would see by way of an earnings trend from this quarter's numbers to decipher where we are headed from here on.
So the key things that I would look for is a revival in earnings for the industrial sector. We've seen fairly strong IIP numbers for the last 4 or 5 months. We've seen fairly good demand conditions in the market, both in the urban market as well as rural markets. Of course, one spoiler has been higher prices for energy and some increase in prices for metals. But my sense is that top line growth and the operating leverage on that should play out in the March quarter numbers for a lot of the companies. So I'm hoping to see, the much awaited revival in earnings finally becoming visible this year in this quarter when we see the results. And if that comes through, then we'll probably, find more confidence in the 20 to 25% earnings growth on average, for the market for the coming 12 months to maybe 6 quarters. And I think a big delta of that earnings growth is actually coming from a rebound in earnings for financials. So over the next 2 months, what we also have to watch for is how this NCLT resolution process for List 1 and List 2 progresses.
Ashwini, hi, morning. So in that light, considering all that could go down with the markets or wrong with the markets has gone wrong in the last 2 months, what with our own markets correcting about 10% from the January top, the year started with that, big shocker in LTCG, there's political uncertainty as well, the state elections haven't panned out as you wanted or you would have wanted or expected them to be with the shocker, especially in Rajasthan coming in by. Would you say, and now with crude prices already spiraling all the way to 72, there is talk of them going all the way up to 80 as well. But irrespective of that, Ashwini, the market has managed to recover half of its lost ground. I mean, today as we speak, we're already back at 10,500 on the index. Would you say that the worst is behind us after the kind of correction that we went through in Feb or March? Or would you say that maybe there could be more to follow?
So, a very interesting question. At the start of the year, when we wrote a newsletter to our investors, we said that, 2018 should be a year of consolidation, don't really expect too much from it. And, the 10% fall that we saw in the first quarter was obviously surprising for many. But at the same time, given the kind of excess that we were seeing in valuations, it didn't come as a huge surprise to us. Looking forward, like you said, that we've already recovered about half the declines that we saw between middle of January to middle of March. We've already recovered half of it. There is a lot of political uncertainty ahead. Globally, there are a lot of events which are becoming harder to predict by the day. So, is the worst behind us? That's a very, very difficult question. My sense is that we'll probably bounce in a narrow range through the rest of the year, with the bottom being supported by an improvement in economic fundamentals and earnings growth, and the downside being exacerbated by political uncertainty in India, as well as global events and global news flow. So I think, that is what is going to play out. Obviously, the valuations are still not so attractive that one can firmly say that the bottom is behind us. I mean, we are not trading at 1 standard deviation below the long-term average price earnings multiple for either the Nifty or for any other benchmark. So it's very hard to say that the bottom is firmly behind us. I think that there can be more downside as the year progresses. Events are very hard to predict. It will be a very choppy year.
Is there a lot of nervousness with regards to the next year general elections, Ashwini, in the market? Is there a lot of political uncertainty which also at one end the market is pricing in, or not just yet?
I think the consensus has already moved to the fact that to an expectation that the BJP may get between 210 to 225 seats in the general elections next year. So the consensus is obviously not pricing in a very rosy scenario. So you're right on that some of the political uncertainty is discounted. But at the same time, when the event is about to unfold, the nervousness that is bound to resurface again. The questions that nobody has answers to at this point in time are that what happens if a 210 to 225 BJP strength comes through? Who will support them? Who will be the Prime Minister? I mean, all these questions are very, very unclear at this point in time. So people are kind of thinking about it, but I don't think people are pricing it in adequately. So as you get closer to the elections, the political affiliations between the opposition and between the ruling party pan out, you have a better sense on what the odds are like. At that point, the uncertainty or the market pricing would become more accurate as compared to right now, when things are still about 12 to 14 months away.
Ashwini, coming to the specifics in the markets, a lot of takeover battles are underway, and I do read as one of your key triggers for the market being high-speed IBC resolution. There are takeover battles on the one hand, then you have these NPA resolutions on the other hand. I would imagine that a lot of M&A activity and this whole insolvency process would also, by the end of the day, give a lot of opportunity to investors. So how are you sizing up these opportunities?
So, the individual outcomes are very hard to predict. So, for example, if you just look at, we usually don't comment on specific stocks, but if you look at what's happening to Fortis Healthcare, and, we don't have any position in the stock, and none of our funds have any interest in it. But the kind of jockeying that's happening there makes the outcome very, very unpredictable. So what we've preferred to do is to play it through the banking sector. I think the sentiment is quite beaten down on private industrial lenders as well as the public sector banks. Valuations are very, very attractive if you're willing to look out beyond the next 6 months or the next 12 months. I think in a lot of cases, the provisioning that is already on the books is adequate to provide for the losses or the haircuts that will eventually come through. So as the year progresses and the NCLT resolutions start to get done, these banks are the ones that will actually see a lot of positive sentiment as their book values start to reflect what the underlying reality is. Right now, there is a lot of fear that we don't know what's going to happen. We don't know how much more they have to provide. There is a memory of the last 8 quarters and of very heavy provisioning that has happened. So, that on one hand is going to be a trigger for the banks. The second thing that should happen for the banks is the fact that as the economy improves, a lot of your small loans, a lot of your MSME loans, which are probably stressed today, not a part of the NCLT process, they should also start to get resolved. We have to remember that 2013 to 2018 has been a very, very tough period for the industry, and to that extent, it is reflected in the NPL of the banking system. And as the economy improves, which is a base case for us at this point in time, we think that the asset quality for the banks will improve, the loans growth will improve. So that's going to be the second trigger. So to answer your question, I don't think we can play this M&A or takeover story by playing individual stocks. I think that those outcomes are very, very hard to predict. But I think one very feasible way to play it is through industrial lenders as well as public sector banks. Of course, it's not easy given all the news flow surrounding these names. But as value investors, we've kind of learned over a period of time that the best time to invest is actually when the news flow is terrible.
Said, and in no way am I trying to push you to comment on a specific story. I just want to give you that caveat. But I do want, Ashwini, your opinion on, maybe at a personal level, but how do you really view this takeover case of Fortis Healthcare in the wake that they are now talking about a hostile bid? The reports are indicating that IHH might be preparing for a hostile bid. Now, I don't see any precedence in the market of, and correct me if I'm wrong, of this being, the way forward from a minority shareholder perspective, as well as what is in it for other stakeholders. How do you view the progression of this story?
So it will be very interesting to see. In the past, there have been attempts where private investors or some large pools of money have tried to take over a listed entity, and by and large, it is the sponsor shareholders, promoter group, or the board of directors that have been able to decide where the company goes. Now, this is a very interesting situation where there is a significant minority interest in the company, which arguably is greater which is at a greater interest than either the sponsor group, which is frankly nothing at this point in time, or the board of directors, who I expect would wish to take the desires of the minority investors into account. So let's see how this plays out, and this is a very interesting test case. We still don't know what IHH will do. So let's see how the bids play out. But this is a very interesting test case where the wishes of sponsors or of the board might be different from that of minority investors, and it will be very interesting to see how that plays out. But there have been situations in the past where minority investors have been able to prevail. I won't get into specifics, but suffice to say that in certain situations where the majority of minority voting becomes essential, the minorities have had their way and prevented some transactions from happening, which might not have led to value accretion for minorities. So I think the awakening or the empowering, let's say, of minorities is on the way, and to my mind that would be a welcome development on the whole.
So Ashwini, since you're building a case that the worst may not be behind us for the overall market, the fact that it's going to be a choppy market with its share of uncertainties, and you don't find valuation comfort as well. So what is the tactical strategy? How is it that you capital protect? What's the investment theme that you follow besides private banks, which you've just mentioned?
So, seek comfort in value. That's the only mantra that we have, and that's what we've kind of done through our professional investment careers. So if there is adequate value in the stocks you purchase, the risk of capital loss becomes relatively lower. So if you were to look at some of the private industrial lenders or some of the public sector banks, I think valuations are quite beaten down. If you look at a lot of the industrial companies that have done practically nothing in terms of stock price performance over the last 3 or 4 years, where businesses seem to be turning around, I think that's another area where things might be interesting. Another area of interest could be cement, for example. Again, stocks have done practically nothing for a long period of time. If industrial recovery takes place, if construction activity resumes, driven by the push that the government is making on infrastructure spending, our sense is that cement demand growth should significantly improve from very low levels that we've seen over the last 4 years. That should help the earnings of the cement companies. Stocks in some cases are extremely attractively valued. That's another area that looks interesting to us. So there are lots of places, and I think it's going to be a very bottom-up market. I think, when I made the comments that the market is expensive and valuations are not in our favor and there's a lot of events ahead of us, that is all true. But that doesn't apply to individual stocks. I mean, the market is made up of companies that trade at 5 times and companies that trade at 50 times, and we are more comfortable looking at the lower end of that valuation range where we feel reasonably comfortable that our capital is protected, and as things improve, we stand to make a reasonable return.
How convinced, Ashwini, are you about the rally that one has seen in IT? The fact that the entire sector and the index itself has moved almost about 30% from October 2017. While the constant currency move is definitely acting as a tailwind right now, but hearing from Infosys, would you think that will largely be the trend wherein they may manage to post an inline set of earnings, but the guidance may not be all that gung-ho?
So you're absolutely right. I mean, the rally that we've seen in IT stocks over the last 6 months does price in, a weaker rupee. It does price in some revival in demand, and especially for the large cap companies, if earnings growth are going to be in low to mid teens, then valuations are very rapidly approaching what I would call fair value. I think the opportunity in IT services may actually lie in the smaller stocks, where I think there is a potential that growth rates for some of the companies might surprise on the upside. And even though some of the names have rallied quite a lot in the small cap space, as much as 50% or so year to date, there are others that have done nothing, and business fundamentals are equally attractive for most companies. The problem in IT services tends to be that investors are very, very focused on quarterly earnings. And I think, one has to use the volatility to one's advantage. If stock sells off post a terrible quarter, but the management is doing the right things and the business structurally is not too bad, I think that would be a time to buy some of these names. So I think what you can only do in IT is trade around the volatility that the quarters offer. Somehow that's become the trend in these names, and that's the only thing you can do. In aggregate, I think the tepid recovery and a weaker currency is getting rapidly priced in. I agree with you on that.
Ashwini, it's been such a pleasure talking to you this morning and hearing your thoughts on the markets and very specific developments on specific companies.
Thank you so much.
Great to have you.